Hello and welcome to the Richard Hunter interview in our new video-only format. I'll still be welcoming guests who know the city best to talk all things markets. You can expect the occasional wild card to be thrown in there for good measure too. In this episode, I'm pleased to be joined by Alex Wright, manager of the Fidelity Special Values Trust. Alex joined Fidelity in 2001, began his career as a pan-European equity analyst rotating across a number of different sectors. In 2007, he chose to focus on UK equities, initially as a UK small cap analyst. As an analyst, he worked closely with both Anthony Bolton and Sanjeev Shah, the two previous managers of the Fidelity Special Situations Fund and Fidelity Special Values plc. Alex began running client assets in 2008 with the launch of the Fidelity UK Smaller Companies Fund, which he ran as lead fund manager until 2014. In September 2012, Alex took over the Fidelity Special Values Investment Trust, and in January 2014, he took over the Fidelity Special Situations Fund. Alex has a BSc in economics from Warwick University, where he graduated with first-class honours, and he is also a CFA charter holder. So first of all, please could you talk us through the investment objective of the trust and what differentiates your strategy from others?
Yeah, so the style of the trust is very much in keeping with how it was managed under Anthony and Sanjeev before, in terms of it's a contrarian value strategy. And that's something that's pretty unusual in the UK. Like, there's certainly less than 10% of the funds in the UK that actually practice a value strategy. And for me, that means buying things which are out of favour and that are undervalued compared to their medium-term potential, and that have generally been discarded by other investors because of some overriding issue, maybe be it on the sector or the company itself. And so we're effectively buying things that other people aren't looking at. And that's how we feel the chance of success is much higher, because we're competing with less people. And therefore there's more likely that you've overlooked what actually is quite a good company, because the overall perception is quite negative.
So with that in mind, do you currently consider there to be particular opportunities in large, mid or small caps, or perhaps all of them?
So the fund invests right across the market cap spectrum, although we've had a definite bias over time towards mid and small cap companies, just because the UK market is so much broader in that area. If you look at the top of the FTSE, it can be quite concentrated. The sort of 50% of the market cap in the UK is in a relatively small number of companies. Whereas if you go down to mid and small companies, you've got a couple of thousand companies to choose from. And also there's much less research there as well. So many less stockbrokers covering those stocks, and many less investors looking for them. So we do have that overall structural bias. That said, there are some very attractive larger companies as well at the top of the portfolio, the likes of the banks, the life insurers, Imperial Tobacco. So that there is, I think, because the UK as a whole is actually quite an unloved place to be, there's actually value throughout the spectrum today.
Yeah, and as you'd say, the trust is predominantly UK focused. Which are the sectors to which you've currently got the largest exposure?
So the biggest exposure of the trust by a long way is to the financial sector, where we've got about 27% invested, and that's spread across about 15% in banks and 12% in insurance. And indeed, that's been quite a sort of structural overweight over the whole sort of 10 years that we've run the trust, particularly in insurance, but also at different times in banks. And I think that's because of the continued reticence of investors to invest in financials post the global financial crisis, because of the very big issues that the sector clearly had and the effect that had on the economy. And also because of the inherent complexity in the sector. It's much more difficult to look at the balance sheet and the P&L of these companies than it is to look at a traditional industrial company. And I'd say particularly smaller boutique managers that maybe don't have the big analytical resources that you've got at Fidelity sort of steer clear of this space. And that presents really good opportunities, because the sector is very different than it was 10 years ago. It's got much better balance sheets on both the insurers and the bank side. And also more recently, the big increase we've seen in interest rates is really different from the last 10 years. and it has a direct effect on the amount of money banks can earn, because traditionally, particularly the big clearing banks, have all had big current account books. That costs quite a lot to run administratively, to sort of run everyone's direct debits, ATM withdrawals, etc. And the cost of that is borne by the banks with free banking for customers. The flip side was that you could always use those zero cost deposits to then lend. Obviously, when interest rates themselves are zero, you don't make any money off that part of your business. So that's been a real problem for banks over the last 10 years at rock bottom interest rates, that what was a very large source of cheap funding, actually that disappeared as an advantage, and banks earned very poor returns on capital for a long time. That's now changing dramatically as interest rates rise.
Okay, and I suspect you may have given us a couple of clues so far, but could you possibly tell us about a couple of your current top holdings or positions and why you find them attractive?
Yeah, so I think a really good place to go is certainly one where we're a bit more maybe differentiated from some of our UK value peers. It's talk about Allied Irish Bank, which is about a 4% position in the fund now. So it's the biggest of all the bank's positions, and one of those sort of non-UK ideas that we can do up to 20%. So this has the same features of that you see at NatWest in the UK, in that it's a big retail bank. But the Irish market then has some additional features which I think are particularly attractive, in that competition is much less in Ireland, because effectively, because of the much deeper financial crisis that you saw in Ireland in 2008, a lot of the banks exited. And so you got to the point where there are only really 5 banks in the whole of the Irish market through most of the last 10 years. And indeed, 2 of them were largely not profitable, Ulster and KBC. And then through COVID, effectively, after having sort of soldiered on for a long time without making any profits, KBC and Ulster both exited. So actually, you've moved from a 5-bank to a 3-bank market. And so that's typically what I like to see when things are, profits are bad in an industry. You tend to see companies actually just shut up shop because you can't make money. And when there's less competition, that means the returns for those who are left are going to be able to do better. And so I think actually, not only do you see the benefits of higher interest rates as the ECB has raised interest rates like the Bank of England, but this time you're actually going to see considerably better market share because 2 of your 4 competitors have gone. And so that means your chance to grow the loan book is there. The housing market had a much longer period of being depressed as well in Ireland, so the loan growth for the system is also better than in the UK, where obviously the flip side in the UK is that actually the housing market's been very strong for quite a long time, and it's probably going to be tougher going forward. So I think, yeah, the outlook for Ireland is really, really good today, and AIB is an excellent play on that.
Sorry to pop in there, but in terms of those, out of interest, in terms of those 2 Irish banks you mentioned, what happened to them? Were they acquired elsewhere, or have they just evaporated?
Yes. So basically, what they've done is they've sort of dismantled those banks. So Ulster was owned by NatWest, and what they've effectively done is written to all their current account customers and telling them they're going to close their accounts so that they have to go elsewhere. And then in terms of the loan books, they've sold those to other banks. So AIB has actually bought the existing mortgage book and corporate book that Ulster is selling. Permanent TSB, the third player, has bought the SME loans, and then KBC, their back book's been bought by Bank of Ireland. So effectively, the lending has been divvied up to the existing players, and the current accounts will also go to the existing players, but they'll actually have to close and reopen. And so that's actually, it's interesting. So I obviously, quite unusually here, own both the buyer and the seller of that black book. But the way it's attractive is that obviously NatWest had been making a loss on those assets because they'd been bearing all the cost of running them, bearing the cost of the retail network, etc. And so being able to shut down all that cost and effectively sell their assets at close to book is actually a benefit for NatWest and a benefit for AIB. So it's a rare sort of win-win situation for those involved.
Sure. And is there another of your top holdings you could potentially talk us through?
Yeah, I think another good one, and because it's the largest stock in the fund, is Serco. This is about a 4.5% position, and has been a long-standing position. We've owned it for about 5 years. Um, and again, I think it sort of highlights sort of what we do. It's clearly a company that 7 or 8 years ago there was a huge amount of negative publicity on, because there were some clear operational failures at Serco, and indeed they were sort of charging the government for things they weren't even doing in terms of sort of overstating the number of prisoners they were escorting. And so there were some clear issues both in the operational delivery of the business, but then also in the accounting of the business, where they were clearly sort of misrepresenting how large their profits were. And as the sector had sort of got tougher with the Conservative government coming in and sort of the austerity years and cutting back on the size of government, that had been very painful for the whole sector. Now, I think what then we saw happen, so the stock price absolutely collapsed. There was need for a fundraising to fix the balance sheet, and then a new management team came in, which really did a huge root and branch review of the business, viewed all the contracts, really improved the culture and cash generation of the company. And I think the market was just incredibly slow to latch onto this, because the issues were sort of so big and so obvious. And also because the sector was so much less profitable. So it wasn't just Serco that had these problems. You could see that across the whole space in the likes of Interserve, Capita, Mighty, etc., Babcock too. A lot of the competition was much lower. So actually new contracts were coming in at much better margins. And then Serco as well was doing a lot of diversification in terms of growing their US business, making acquisitions in the US, growing their Australian business. And so now actually Serco is only about a third a UK business, and is actually 2/3 overseas, with the US by far and away the largest market. And that's very attractive, because outsourcing of government in the US is considerably below where it is in the UK. So the UK really leads the world in terms of the percentage of governmental services that are outsourced. And clearly, obviously, the size of the US market is that much bigger as well. So being able to sort of take the expertise from a very outsourced market, where things are done very efficiently because of years and years of providing these services in the private sector, is really a key competitive advantage. And so this is a sort of a global leader now in sort of government outsourced services, strong sort of 5-6% margins, and similar sort of organic growth, with the potential for more acquisitions as well. And also does a very high return on capital. So it looks like some of the very best sort of non-cyclical staples businesses in the UK, very similar metrics that you might see at sort of a Reckitt's or a Unilever or a Diageo, but actually trades on about sort of 12.5, 13 times earnings, compared to those companies which trade on anywhere between sort of 16 and 20 times earnings. And indeed, that's where Serco used to trade 15 years ago in the market, before it had those big problems. So a company that, it sort of really personifies the process as a whole, sort of something that was really hated, really unloved sector, really misunderstood, but as actually a really great long-term, really quite defensive business, which is why it's the largest one in the portfolio today.
And of course, at this point, it's always worth us reminding ourselves that because we're talking about UK stocks, we're not necessarily talking about companies which are constrained by just trading in the UK. Clearly, that puts no constraints on your portfolio either.
Yeah, so you're right. If you just look at the market, the FTSE All Share is 75% of its earnings come from outside of the UK. So it's actually only a quarter of earnings. So actually a reasonably small subset of the market that is linked to the UK market. Our fund as a whole is probably more like 40% exposed to the UK, because I think that is where some of the best value lies. So particularly, the life insurers, the UK banks. But even with my fund, it's still actually more than the majority of ex-UK.
Okay, so with all of that, all of the foregoing in mind, what's your sort of outlook from here, and the challenges that we've currently got, and how are you positioned?
Yeah, so I think Clearly there's a lot of geopolitical and economic uncertainty globally, and clearly sort of the world is grappling with inflation rates that it hasn't seen for sort of 20-30 years. But I suppose this sort of there being a lot of uncertainties is something we've dealt with a lot in the 10 years that we've been on the trust. There's been some obviously completely unexpected things happening, be they sort of the Brexit vote, Donald Trump becoming leader of the US, the COVID pandemic. And actually, when you look back in hindsight, all of those have been great opportunities, because when the market focuses on one particular thing and it's very myopic and sort of panics, that's where you get those real stock specific opportunities. And I think we're very much in one of those today. Obviously, all the focus on the bond markets and the political issues in the UK with the Truss leadership and the war in Ukraine is really causing a lot of volatility, and the opportunity set, I think, is therefore really quite wide. Now, I think we need to be careful, particularly as we go into what is, I think, an inevitable recession, which is coming up. But also we need to make sure that we take advantage of those opportunities, so we don't just hide in sort of more defensive companies like Serco. We start to buy into some of the more cyclical areas, and that's where I'm sort of moving now, sort of looking for new ideas, particularly some down the market cap spectrum where there might have been forced sellers. I think now is a time of actual great opportunity, which always comes when you get these times of also great risk.
Fascinating. Well, unfortunately, that's all we've got time for. So many thanks again, Alex, for your time and for those valuable insights. And thank you for watching. By way of reminder, this show is free to subscribe. Just search for Interactive Investor on YouTube and hit the red subscribe button. And of course, you can find much more by the way of investment ideas and insight at ii.co.uk. I'll be back soon with another Richard Hunter interview. Bye for now.